perfect encapsulation of the environment we've been in for the past 6 months, but is it possible we're about to see a major regime shift?
So Kelly, I think, there's only two certainties that we have going into the second half of the year. There's all this stuff going on, but there's only two certainties. Number one, profits growth is going to decelerate. We know that. We know the comparisons are very easy. Now they're very hard. Profits growth is going to slow. And number two, the Fed's going to tighten. Now, if I asked you to take combinations of profits growth and Fed tightening or easing, I'm sure you would not choose the Fed tightening and profits growth decelerating. And that's the worst combination of the four that you could possibly come up with. So what we're doing is we're straddling kind of late cycle and defensive. And I think what's very interesting is that the discussion in the markets has been pretty consistently, do you want growth or cyclicals? Only recently are you getting discussion about defensives and true defensives, which is interesting given that everybody's fearful of a recession when defensives work the best in a recession.
Can you go from late cycle to early cycle without having to end the cycle in between?
I sort of doubt that. I suppose it's possible. Anything's possible. But history says you really go from late cycle to defensive and then from defensive to cyclicals. And that was my point about potato chips versus computer chips. Then when everybody is embracing potato chips and nobody's talking about computer chips, that's probably your signal that we're at the bottom in technology.
So when you say we've toned down the cyclicality in our portfolios, put some sharp names on that. In other words, that means sell this, buy that, and I don't mean you have to name specific companies, but sectors.
Sure. So Tyler, we were very overweight the energy sector. It's really been my favorite sector for the past couple of years, since, after the pandemic, the 2020 story into 2021 into early 2022 was all really about energy. And we were dramatically overweight energy in our portfolios. We're now slightly overweight energy, and we're now more overweight consumer staples than we are energy. That's a huge shift in our portfolios. Whether you look at energy, you look at materials, you look at industrials, we're still overweight that group as kind of the late cycle play, but consumer staples is now our biggest overweight.
But so I want to go back to what you said a moment ago, Rich, when you said that we go from sort of defensives then to cyclicals. Can you talk a little bit about that? And like you said, if now you're seeing maybe some signs of a breakout in technology, what would that tell you?
Well, I think right now the breakout in technology is a little bit of a head fake. I think that people think that somehow we're magically going to return to 2018, that inflation subsides, the Fed stops tightening. It's all beautiful, and we go back and talk about tech, innovation, disruption, and cryptocurrencies. We just don't think that's a very realistic scenario, that you're really not going to squash inflation without some kind of meaningful slowdown in the economy. We could talk about whether it's a recession or not, but you need a real meaningful slowdown in the economy to squash inflation here. And so we don't think we're just going to return to 2018 like it was all just a nightmare, a bad dream. We'll wake up tomorrow. We don't think that's going to happen.
So how long do you think defensives can outperform, given that they've already outperformed for the first half of the year?
Yeah, so, that's kind of a function of how aggressive one thinks the Fed's going to be. My personal opinion is the Fed hasn't even started getting aggressive yet, given that the real Fed funds rate remains historically negative, and every recession in the last 50 years has been preceded by a positive real Fed funds rate. So we have a historically negative real Fed funds rate when usually it's a positive one that precedes recession. So I'm not even sure, my personal opinion, I'm not even sure that the Fed has even started to get aggressive yet. They're talking the talk, but our story has been that they're hunting elephants with pea shooters.
And in that case, this could still all have some legs or some room to run.
Right, exactly.
All
like
right.
An elephant getting hit with a pea. Right.
Wouldn't want to be near that one. Richard, thank you very much. It's good to see you today. We appreciate it.
Thanks, guys. See you later.
Rich Bernstein. Coming up, if you want to look at a stock that Wall Street can't make up its mind about, look no further than Netflix. Just this month, it's had as many up days as down ones. So where does it go from here? We've got an old school bull versus bear debate ahead. Before the break, though, let's get a quick check on some of the names bringing the NASDAQ higher. Here's technology outperforming with Datadog up 23%, Okta and Zscaler up nearly 20%, Mercado Libre and Lucid up more than 15%. We're back in a moment.
All right, welcome back to Power Lunch, everybody. Big news day today and a big market day. Let's go to Dominic Chu at the New York Stock Exchange for a look at today's rally. And as Kelly pointed out, we're going to have a green week, it appears.
And a strong one, right? I mean, a pretty decent-sized rally we're seeing. It's broad-based, Tyler, to your point as well. Markets have been pretty much hovering at or near these levels, the session highs, pretty much since noon at this point. The Dow, the S&P, the NASDAQ, each gaining north of 2% on the day. But it's even the small and mid-cap stocks that are doing even better than that, up 2.5% to sometimes 3%. Now, from a sector perspective, it's the economically sensitive ones. Talk of financials, materials, industrials that are leading the way higher. And as you might suspect, the other end of the spectrum is the laggards, right? The defensive sectors like healthcare, consumer staples, utilities, those sorts of stocks. Now, some of the stocks themselves posting big moves to the upside include the transportation names, thanks in large part to FedEx, because the shipping and logistics giant reported mixed quarterly results, but it did say it expects a key measure of profits to rise in its current fiscal year. Oil and gas stocks also posting solid gains, trying to really reverse some of the steeper losses we've seen in just the last few weeks. Exploration and production upstream names like EOG Resources, Occidental Petroleum, Hess, Diamondback Energy among some of the best performers in the S&P 500 energy sector. On the downside, though, check out what's happening with LendingTree, not in the S&P, but the online lender lowered its second quarter guidance, saying rising interest rates and inflationary pressures have hit its business. So some upside names, but still some downside names, Kelly, in this market. Tyler, back over to you.
All right, Dom, thank you very much. Let's turn to Rick Santelli in Chicago now, where bond yields are turning higher again after being down sharply so far this week, Rick.
Yes, down sharply so far this week really does summarize it. And University of Michigan sentiment at 50 was a 44-year low, going all the way back to 1978 record keeping. But we did come off on the 1 and 5 to 10-year inflation rates just a bit. And that definitely seemed to make a difference briefly as you look at the intraday of 10-year note yields. Right as that number was being released, we were at a 309 yield. You could see yields are now close to 312, so we're higher. But that does give you an idea. It put a lot of volatility in anything when inflation moves the market. Let's look at a 2-week of 10s. Boy, we had an intraday high at 350. We had a high close at 347, and here we sit at 312. Quite a difference. Fed fund futures, well, if you look at a 2-week chart, we're 22 basis points above the low close. And that's almost a quarter point taken off the table. But from the intraday contract lows, we are 31 basis points higher. Remember, higher means less Fed built into that contract, and that contract always seems to get what it wants with regard to the Fed. Finally, the dollar index. We all know with interest rates kind of coming down a bit, Fed fund futures higher, the dollar index has come down a bit. It's down for the day, down for the week. But as you look at a 1-month chart, we're not that far, a penny and a quarter away from the high close you see there, because it goes all the way back 20 years to Dees 2002. Tyler, Kelly.
Rick, I promised last week I was going to ask you a Friday question every week. It's got to be quick. What did we learn this week?
We learned this week that there's a tale of two Fed chiefs. The one Fed chief during COVID times was a cheerleader for more fiscal stimulus, as evidenced by many headlines like in the Financial Times. But this week, it was all about sticking to his knitting, didn't want to talk about past, present, or future when it came to fiscal policy. I'm not sure I agree with that approach. That kind of made me want to do a little riff on that, Tyler, and thank you for asking.
Did I tee the ball up for you or not? Rick Santelli, thanks.
You certainly did.
Ahead on Power Lunch, a bull bear binge. We debate Netflix as the streaming giant faces an uncertain future, laying off more employees, raising prices, shifting towards ad-supported content, dealing with strong competition. The stock is up 5% today. We'll be back in 2 minutes. All right, welcome back. Wall Street growing more and more divided over Netflix and the future of that streaming giant. The stock down nearly 70% this year, and investors are starting to ask the question Netflix asks every time you fall asleep on the couch after binging Stranger Things. Are you still watching? Some of the top issues on our watch list: subscriber losses, streaming competition, rising costs leading to layoffs, price hikes, adding an ad business, and takeover potential. Takeover? They were supposed to be the buyers of everything, not maybe a seller. We've got a classic bull-bear debate. Wedbush's Michael Pachter is our bull with an outperform of $280 on the price target, and Benchmark's Matthew Harrigan is our bear. He says sell. $157 price target. Michael Pachter, the longest guy running bear on Netflix, has changed his stripes. Why?
Mostly because I have integrity, and I actually think the stock's worth 280. So when it was trading at 600, it was a sell, and when it's trading at 190, it's a buy.
And did you think that your I'm not going to call them colleagues, but your fellow analysts who kept saying that the stock was going to keep running, obviously it did for a long, long time, and then it stopped. Are you saying that they are equally wrong now in thinking, like Matthew does, that it's going to go down, 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 down? In other words, the wisdom of crowds or the madness of crowds?
You know, I don't want to disparage Matthew, and I don't know what his thesis is, so we'll let him speak for himself. But I think on the way up, it's a tendency of the sell side to tell you what just happened and extrapolate and tell you why that's going to continue to happen. And on the way down, same thing. So, you know, I think these guys had a hiccup. I mean, clearly competition caught up with them. Clearly subscriber growth slowed. They're kind of a victim of an outdated model where they dump all the episodes at once. They're beginning to emulate the competition there. They're picking up ad support, so they're emulating the competition there. They're starting to cut costs. They're starting to focus on not making as many movies. So I think if they focus on the bottom line, they're going to deliver profit growth. And profit growth, maybe it's not worth 600, but it's worth 280.
All right, Matthew Harrigan, your turn. Hiccup or Heimlich?
Oh, I think it's probably more of a Heimlich. I think people have really approached this as a tech name, more or less a winner-takes-all outcome, or somewhat in that direction at least. And I really think it's a media name. We've been pretty agile in our ratings. I've had buys on this before. Unfortunately, I upgraded it from sell to neutral after Q4 came out, and then somewhat unfortunately, we upgraded or downgraded it again to sell from neutral fairly recently. But I think if you kind of apply valuation parameters for media stocks, we're